$11 billion.
That is, I mean, that's a number that's honestly hard to wrap your head around.
It is staggering. To put that in perspective for you, that's roughly the GDP of a small country.
Yeah.
It's more than the annual budget of some entire U.S. states. But according to the Federal Reserve Bank of Chicago, that's the estimated amount of specific tax credits that go unclaimed every single year.
Just sitting on the table. And to be clear, this isn't, money lost in the couch cushions of the Capitol building. It's sitting right there in the IRS tax code, designed for businesses you and I interact with almost every day.
It sounds like a scam, doesn't it? If I got an email saying you have unclaimed billions waiting for you, I just delete it.
Of course. You'd think it was a phishing attempt.
Right, or Nigerian prince. But today, we're unpacking something that is very real, surprisingly lucrative, and as of this year, we're in January 2026, it has completely changed the game for a huge chunk of the service economy.
It really has. We're talking about the FICA tips tax credit, or IRS code section 45B. And before you tune out, because I said IRS code.
Yeah, my eyes are glazing over already.
I know, but you need to know this. For the average eligible business, the median refund we're seeing is around $101,000.
$101,000. Okay. IRS code section 45B just got a lot more interesting.
A lot.
That's not a rounding error. That's payroll for a year. That's a renovation.
Exactly. I thought that number might grab you. This isn't about, writing off a new stapler. This is capital that keeps businesses alive.
So our mission for this deep dive is to understand two things. First, why the government is basically paying businesses to be honest about cash tips. And second, how a piece of legislation passed last year, the One Big Beautiful Bill.
I still can't believe that's the name.
The OBBB. I know, it sounds like a float in a parade, not something from Congress.
It is certainly memorable. But the name kind of fits the impact. Effective as of December 31st, 2024, it totally reshaped the landscape for this credit.
And we've got a stack of sources here today. Tax advocacy breakdowns, the new legislative text, IRS guidance docs. So let's dive in.
Let's do it.
Okay, let's start with the problem. Why does this credit even exist? Usually the IRS is trying to take money, not hand it back.
Well, to understand the credit, you have to understand the friction of tipping. Think about how it works. If you run a restaurant or a salon, your employees are getting money directly from customers.
Right. It never touches the business's bank account. If I hand a waiter a $20 bill, that money goes right into their pocket. The owner never sees it.
Exactly. And that creates a huge friction point because under tax law, that tip is still considered wages paid by the business.
Even though the business didn't pay it.
Yes. And because it's wages, the employer is responsible for paying FICA taxes, Social Security, and Medicare on that money. Right now, that's 7.65%.
So wait, let me get this straight. I own a restaurant. A customer leaves my waiter a $100 tip. That goes straight to the waiter. I don't see a dime.
Not a dime.
And I, the owner, have to pay $7.65 to the government just because my employee got tipped.
Precisely. It feels like a penalty for having good tipped staff. The better they do, the more tips they get, the higher your tax bill goes.
That's a disincentive to report it.
A huge one. And for a long time, reporting was terrible. Before this credit existed, sources estimate only about 15% of tips were actually reported.
I believe it. Why would you? It just costs you money.
Right. So the government created Section 45B. It's a carrot, not a stick. They said, look, if you report these tips accurately, we will give you a dollar-for-dollar tax credit to offset that FICA tax you paid.
Okay, and we need to pause on that word credit. You always tell me this is important, but people mix up credit and deduction all the time.
It is the most important distinction. A tax deduction is like a coupon. It just lowers your taxable income. So if you make $100,000 and have a $10,000 deduction, you get taxed on $90,000. It saves you pennies on the dollar.
So a deduction is a discount.
Right. A tax credit is a gift card. It's cash. It lowers your actual tax bill dollar for dollar. If you owe the IRS $50,000 and you have a $50,000 credit,
you owe zero.
You owe zero. It's a massive difference. And yet, our sources say 80 to 90% of small businesses that are eligible never claim it.
That's the part that baffles me. Is it just that people don't know?
It's a massive blind spot. Most people think their payroll provider handles it automatically, but they often don't. Or business owners confuse it with other wage credits. So it just sits there, unclaimed.
Well, let's talk about who can claim it, because as of last year, that list got a lot longer.
A lot longer. The One Big Beautiful Bill signed on July 4th, 2025.
Very patriotic. Now, historically, this was just for food and beverage, right? Burgers and beer, you're in. Cut hair, you're out.
That was the line in the sand. But the OBBB erased it. Effective for tax years ending after December 31st, 2024, the credit expanded to include the beauty and personal care industry.
Okay, beauty and personal care sounds broad. What does that cover?
It's intentionally broad. We're talking hair salons, barbershops, nail care, aesthetics, spas, body treatments. If you have W-2 employees who get tipped in that space, you're now invited to the party.
Okay, I want to drill down on aesthetics because I saw a really interesting nuance in the notes about med spas.
Yes, that line gets very blurry, and the IRS hates blurry.
I can imagine. So you go in for a facial, but you might also get Botox.
Right. And the rule of thumb here is customary tipping. If you go to a med spa and a registered nurse injects Botox, do you tip them?
No. You don't tip medical professionals. That would be weird.
Exactly. It's not customary. Therefore, tips on those medical procedures do not qualify for the credit.
But the esthetician doing a facial in the next room.
That is a customary tipping rule. So in one building, the medical side of the business might not qualify, but the spa side absolutely does. You have to segment your payroll.
That sounds like a headache, but for $100,000, it's probably worth it.
Absolutely.
Yeah.
But there is one other catch for the beauty industry, the 15% threshold.
Right. This is new with the OBBB.
It is. For these new beauty and personal care businesses, their tip income has to be more than 15% of their gross receipts to qualify. It's a filter, basically, to make sure this goes to businesses where tipping is a fundamental part of the model.
Got it. Okay, so we know who's eligible. Now I want to get into the math. Because when I read the notes on the frozen minimum wage, my jaw kind of hit the floor. This feels like a cheat code.
This is the secret sauce. This is why the credit is so incredibly lucrative.
So explain this, because usually minimum wage only goes up. But for this tax credit, we're basically time traveling.
We are. The law says the credit applies to FICA taxes paid on tips that are in excess of the minimum wage. But, and this is the key part, it doesn't use the current minimum wage. It uses a historical frozen baseline.
For when?
For the food and beverage industry, the law lets them use the federal minimum wage from 2007.
2007. What was it back then?
$5.15 an hour.
$5.15. I haven't seen that number on a pay stub since I was a teenager.
And that's the massive benefit.
Yeah.
Because the base is frozen so low, almost every single dollar of tips is considered in excess of that base.
And the beauty industry, do they get the 2007 rate?
No. Since they were just added, the OBBB set their baseline at $7.25 an hour.
Which is the current federal minimum.
Yes. But think about it. In many states, the actual wage you're paying a stylist is much, much higher than $7.25. So a huge portion of their tips still fall into that in excess bucket.
So even if I pay my stylist $25 an hour, the credit calculation only cares about the tips earned above that frozen $7.25 baseline.
Exactly. It means that as inflation pushes tips higher, the credit naturally grows. It's an escalator for your refund.
That's fascinating. But we have to define what a tip is, because I see service charges and kitchen appreciation fees everywhere now. Do those count?
This is where businesses get into so much trouble. The IRS has a very strict 4-part test for what a tip is.
Okay, what's the tip?
1, the payment must be free from compulsion. 2, the customer must have the unrestricted right to determine the amount. 3, the payment can't be set by employer policy. And 4, the customer decides who gets it.
Okay, let's use an example. A restaurant automatically adds an 18% gratuity for my party of 6.
That is not a tip.
But it says gratuity.
Doesn't matter what they call it. It fails the free from compulsion test. You are required to pay it. The IRS calls that a service charge.
And that doesn't qualify for the credit.
Correct. It's treated as regular revenue. That auto gratuity trap is costing businesses a fortune in lost credits.
So how do they fix it?
Just change the mechanism. Instead of making it automatic, just show suggested amounts on the receipt, 18%, 20%, 22%, but leave the line blank for the customer to fill in.
And then it's a tip.
Then it's a tip, because the customer chose the amount. It's a definition with very expensive consequences.
What about for the beauty industry? You mentioned booth renters. This seems huge for salons.
Critical. The credit is for employers paying FICA tax on W-2 employees. If your salon is a booth rental model where the stylists are independent contractors, you can't claim this credit. You aren't paying the employer's share of FICA, so there's nothing for the government to credit you back for.
So this credit completely changes the math on whether to use a W-2 model versus a rental model.
It changes the entire profit model. In some states, it might actually make having employees more profitable.
Speaking of states, let's talk about geography, because where you live changes the math on this drastically.
It does. This is where state minimum wage laws collide with this federal tax credit, and it creates some really counterintuitive results.
Let's look at the no-tip credit states.
Yeah.
California, Washington, Oregon, places like that.
Right. In those states, an employer has to pay the full high state minimum wage directly. They can't use tips to make up the difference.
And those wages are high.
Mm-hmm.
Washington is over $17 an hour now.
It is. It's a high labor cost. But remember that frozen baseline for food and beverage.
$5.15 an hour.
Yes. Since you're already paying a wage of $17.13, you have more than satisfied that $5.15 baseline with the hourly wage alone.
Wait, I see where you're going with this.
It means every single dollar of tips that employee earns is now considered in excess. 100% of it.
So the fact that I have to pay them a higher wage actually helps me maximize the tax credit.
Exactly. It turns a high labor cost state into a high tax credit state. Business owners in California and Washington, in this specific instance, win big.
That's mind-bending. So what about a state like Texas, which follows the federal rules?
There, an employer might pay a base wage of only $2.13 an hour and use tips to get the employee up to the minimum.
So some of those tips are just being used to hit minimum wage.
Right. And those tips don't qualify for the credit, so the qualifying bucket of tips is much smaller in Texas than it is in Washington.
So if you're in a high-wage state, you are likely leaving the most money on the table.
The most.
Yeah.
You need to be looking at this immediately.
Okay, let's get practical. I'm listening, I own a spa, and I realize I've never done this. Is that money gone forever?
No! That is the best part. You can go back 3 years.
3 years.
Yes. You can file amended returns using Form 8846. It's like a savings account sitting there with the IRS. For a busy restaurant, that could be a check for hundreds of thousands of dollars.
That saves a business. That's a second location.
It is. Now, what if you're a startup and you're not profitable yet, so you don't owe any income tax?
Yeah, what happens to the credit then?
It's a non-refundable credit, which sounds bad, but it isn't. It just means the IRS won't write you a check for more than what you owe. But it has a carryback of 1 year and a carry forward of 20 years.
20 years.
Yes. So you bank it. You keep that credit on your books. When you do become profitable, you have this massive tax shield waiting to wipe out your future tax bills.
That's incredibly valuable. But there's always a catch. The double-dipping rule.
It's a fair rule. You can't deduct the FICA tax as a business expense and claim the credit for the same amount. You have to pick one.
And you always pick the credit.
Almost always. A deduction saves you pennies on the dollar. The credit saves you dollar for dollar. It's just better math.
Now, I have to ask about the elephant in the room. Audits. Does filing for a big credit like this put a target on my back?
It's a common fear, but the sources we reviewed say no, not inherently. The IRS expects businesses to claim the credits they're entitled to. As long as you have your documentation, your tip reports, your payroll records, you're safe.
Don't guess at the numbers.
Oh, guess.
I want to zoom out for a second. There was another legal shift recently that I'm sure you loved reading about. The 80-20 rule.
Ah, yes. The infamous 80-20 rule. That was a headache for years.
What was it?
It was a rule that said if a tipped employee spent more than 20% of their time on non-tipped work like rolling silverware or prepping garnishes, the employer lost the credit for those hours.
That sounds like a nightmare to track.
It was an administrative nightmare. But in 2024, the Fifth Circuit Court of Appeals struck that down.
So it's gone.
For the purposes of this, yes, the strict limitations are gone. And the source material highlights that with the 80-20 rule removed and the OBBB being added, we are in what they call a golden era for this tax break.
It's a perfect storm. The barriers are lower, the industries are wider, and the payouts are higher.
Exactly. If there was ever a time to look at your payroll, it is right now.
So let's bring this home for everyone listening.
If you own a business in food, beverage, or beauty, you need to check if you are filing Form 8846. Call your accountant. Ask them specifically about the FICA tips credit. And if they don't know about the OBBB changes for beauty, you might need a new accountant.
And if you're an employee, a server or a stylist.
You might think, why should I care if my boss gets a tax break? But think about it. This credit rewards businesses for having W-2 employees and for reporting tips accurately. It helps keep the business solvent and able to offer benefits. It's good for everyone.
That's a great point. It aligns the incentives for everyone. The boss wants the tips reported. You want them reported for your Social Security. It's a win-win.
And claiming the credit does not hurt your Social Security benefits. That's a key point. It's a pure win.
Well, I have to say, I finally understand why people save receipts.
It's documentation for a very nice refund check.
Exactly. We've covered a lot today. The one big beautiful bill, the $5 time machine. But the bottom line is, the money is there.
It is $11 billion of it.
Go get your slice. That's it for this deep dive. Thanks for learning with us.